Hello, I'm Jason Arp, and I'm going to give you a presentation on the business personal property tax exemption legislation that Paul Inslee was so gracious enough to co-sponsor with me, and we were going to have a vote on this in late August. Okay, let's get started. The presentation is called Getting Out of the Way. That seems to be the most logical answer to our economic development issues. All right, first of all, let's um, take a look at what works. The Economic Freedom Index is put together each year. They take a look at the countries in the world based on some factors. The five major factors that they use are the size of government, that's mostly taxes as a percentage of GDP. They look at the legal structure, the rule of law and property rights, as well as business regulation, trade regulation, and sound money. This is the Fraser Institute out of British Columbia in Canada that does this. They cooperate with economists all over the world. Well, two of those factors are not going to really play into Fort Wayne city government, trade regulation, and sound money, but there are some things we can do about the first three items to make sure that we create a business-friendly, economically free area. And the results of the studies that the Fraser Institute has done over the last 40 years has shown that economic freedom plus the rule of law, and those two things are both needed. Um, those two things is a formula for prosperity. So how are we doing here in Indiana? Well, from a taxation standpoint, we're very middle of the road. This was a national survey done. I think it was published by Wallet Share. Our own uh, Andy Downs from IPFW was one of the contributors to this. This takes into account property tax, individual income taxes, as well as sales and excise taxes, all as a share of personal income. And as you can see, the totals of those revenues um, on a per capita type of as a percentage of total personal income. You can see the Indiana's middle of the pack, number 24. So we have a very middle of the road tax policy. Total income taxes in Fort Wayne are 4.71%. That's a combination of the state's 3.23% and the local income tax, which Fort Wayne City Council just boosted last year of 1.48%. And Indiana ranks, as I showed you on the prior chart, 24th. I've got 25th on the slide. We'll make an adjustment for that. The average residential tax of 0.82, Indiana is 23rd lowest in residential taxes. These are not necessarily bad. Like I said, they're average, middle of the road, but it's not a beacon for migration. People aren't going to come here because of our tax policies. So how are we doing on the rule of law property rights issues? Well, we've got all kinds of insider dealing at our Economic Development Corporation. We have major conflicts of interest and major projects between the executive of the Economic Development Corporation and um, the developers of the projects. We had arbitrary treatments of abatements and other one-off tax incentives. It seems like that's the bulk of our economic development plan. Um, and then some businesses end up paying higher taxes, some of the highest taxes actually in the country, while others pay little to no tax. We'll get to that last point in a moment. One big positive that we have is real estate prices. So we have low real estate prices that offset much of the higher taxes on property and income. So we have the fifth cheapest housing market in the country. And as far as like commercial real estate, office rents are cheaper than any other major market. As you can see here, here's the average listing of new home prices. And you see Indiana there is 5th from the lowest. And here you have office rentals per square foot. You see Fort Wayne is cheaper than most. So why in the world will we subsidize real estate if we have one of the cheapest real estate markets in the country? Wouldn't it make more sense to remove actual obstacles to growth? What would be a binding constraint? The Tax Foundation works together with KPMG every few years to put together a location survey. It takes a look at doing business in different states across the country. And in the 2015 iteration of this, you see that Indiana came up dead last in the country for a tax environment for capital intensive manufacturers. Again, the source of this is KPMG and the Tax Foundation. The effective rate on capital intensive manufacturers, so like if you were to think of it as an income tax percentage, would be 19.2%. Compare that to some of our neighbors. You can see Ohio at 5.1%. On mature labor-intensive manufacturers, we're looking at 13.5%, so not a whole lot better. And you can see Michigan at 6.3%. So how does the business personal property tax create a bad economic environment? Well, take for instance a company that has sales of $100 million a year with a profit margin of 10%. It would give you a profit of $10 million a year. Let's also say that they have equipment on their balance sheet that is roughly the same as the sales, and that's pretty typical for a large manufacturer. Say the assessor has that assessed at $40 million, so it's either been depreciated or the assessor's got a lower amount for it. Then your business personal property tax rate, let's just say it's 3%. Use nice round numbers. It gives us a tax of $1.2 million on that equipment. So if you take the tax and divide it by the total profit, that would give you an income tax equivalent of 12%. So it looks like the obstacle that we could remove would be the business personal property tax, which are too high. And we could also work on our current economic development environment, which turns the rule of law on its head. It's expensive, inefficient, and ineffective. So what is business personal property? This is tangible property that is used to produce goods or perform services. So computers, printers, communications equipment, MRIs, CAT scans, X-rays, labs, surgical equipment, lathes, CNC, drill presses, ovens, conveyor belts, extruders, lifts, welding equipment, industrial robots. You get the point. It's all business equipment. So our ordinance, S18-0632, exempts all new business personal property from taxation. So think of it as somewhat of a super abatement for all new investments. The business personal property that is on the rolls will remain on the rolls until it is retired. It may take more than 10 years to retire the current stock. And this is based on data from the Allen County Assessor's Office that I was given a couple of years ago, actually, in 2016 when we brought this up the last time. Based on the run rates at that time, it would have taken 15 years to retire our property. And this is all made possible by Indiana Code 6-1.1-10.3. This was the State Senate Enrolled Act 1 passed in 2014. So this was a pretty high priority item for the Indiana State Senate. So taking a look at the composition of our property taxes currently, you see in blue here we have real property. The red is income taxes. It's called a property tax relief credit income tax. It gets treated as property taxes. We have the actual personal property in green. Then there's a little purple sliver that's also income taxes, PTRC, that's treated as personal. All right, and then you see the distribution. This is where our taxes go. So this is all the property tax distributions. You see schools, cities and towns, county are the large ones, and then the rest of it's broken up between the township governments, the airport, CityLink, and the public library system. This slide here gives you a lot more detail on that. You can see how much business personal property is in each of these taxing units. And you can also see in the middle of this, you've got the total TIF, total abatement, total tax inducements, and then we've got this shift column and net phased in impact. So you may want to come back and reference this later if you have some questions about individual units, impacts, and what they currently are giving up through TIF or abatement. All right, so another source of income for governmental units here is income taxes. You see the property tax makes up about 70% of the taxes, and 30% roughly comes from income taxes. You see the income tax allocations. A fairly sizable portion of that is treated as if it is property tax. That's the PTRC. That stands for Property Tax Relief Credits. You see the purple part is now just called distributed shares. So this gets treated, it gets sent to the general fund of the different governmental units. You have the EcoDevo, that's your economic development is in the red there. So that's pretty much the largest portion of our income taxes go to economic development. So that's going to be things that get, bond payments for various community development projects. And then finally, in green is the smallest sliver of the income taxes goes to public safety. All right, so here we have the business personal property tax transition. So currently, it's roughly $56 million countywide. As I mentioned earlier, the runoff period is about 10 to 15 years. We're going to use 10 in our numbers for this demonstration. So 33% of the 18 million of the revenue sources will shift to real property. And so the loss after 10 to 15 years, when I say loss, the reduced revenue to governmental units would be about $37 million once this is finally phased in. $37 million less per year starting in year 10, let's say. First year, you're only talking about $2.5 to $3.7 million across all units in the county in the first year. So part of that is the way that the levy is calculated. So the way taxes are done, the units put in for a levy, the auditor determines what the amount that they can charge in total property taxes, and then that gets kind of applied to all the existing property. So as a business personal property is retired, the levy will force rates up on property that are below the caps. So the first year impact would be somewhere between $1.25 and $1.9 million countywide, and kind of the shifting. And that can be mitigated through changing the way that the property tax relief credits are handled. So right now we've got 3 million of that is going to reduce the taxes on business personal property. So instead, what we could do there, and council could change these distribution percentages at any time. We get a window of once per year to revisit these, and perhaps we can do that to offset the impact. So we could reduce the shift right there from 18 to $15 million. And this could be further mitigated on residential properties by changing the distribution of PTR credits to 3% properties. Instead, have that amount distributed to 1% properties, which would be your households. So in other words, we're taking our, go back a slide here, we're taking our $18 million shift and making it $9 million. So basically cutting the impact in half. So TIFs currently we've got two different major types of tax inducements for business activity. TIF, which is tax increment financing, collects $17 million annually. The tax increment financing captures the assessment increases within the TIF district. The revenues and the TIFs are managed by the Redevelopment Commission. So you've got an Allen County Redevelopment Commission, you get a Fort Wayne Redevelopment Commission, and its purpose is to finance public infrastructure. So, some public infrastructure that we've seen recently is the HVAC system and various steel in the Skyline Tower. The roof for the landing building was deemed to be public infrastructure. My guess is you would have a difficulty as a citizen accessing these items that you've paid for these taxes. All right. Current tax inducements also include abatements. So a tax abatement would be where the amount of tax that you pay in the first year is reduced substantially, maybe none at all in the first year, 10% the next year, and so forth till it's phased in. On a 10-year phase in, you may have a 7-year phase in or 5-year phase in. And some of these are not phase-ins at all. That's no taxes at all for 10-year period. That's called super abatement. It's happened a couple times in Allen County. General Motors is the largest. Another one to note is the Cityscape Flats, which is a residential apartment building next to the baseball diamond downtown, received super abatement. So if you look at the abatements, we abate nearly $10 million of real property and $8 million of business personal property. And here you can see kind of a breakdown by unit. So let me kind of show you here, like here would be schools. So the blue there would be TIF, and then the red is abatements for real property, and the green is abatements of personal property. But if you look at a total of that, it equals roughly equals the amount of business personal property that we collect or apply to those districts. So this is what we're talking about getting rid of. Phasing out would be the business personal property, and that would be offset by reductions and abatements and tax increment financing. Here, this kind of shows in aggregate across all sources here the business personal property revenues declining. Simultaneously, you've got the increase of revenues as the existing book of tax inducements roll off. So this shows in a hypothetical zero growth world, starting in a year from now for the next 10 years, what that would look like. And basically we would be flat. The personal property is indicated in purple, whereas the inducement phase out shows an increasing of revenue in orange to basically offset the loss of the business personal property. And this is what that would look like with 1% overall economic growth, or growth in property values, I should say. It's the assessments going up 1% per year over the next 10-year period, what that kind of looks like, and 2%. So kind of normal growth. None of what we're doing would be felt. All units would end up with a lot more money than they have currently. And this doesn't assume any actual growth in the economy due to what we're talking about. I suspect if we made this that popular of a move by eliminating that business personal property tax that will have tremendous economic growth, but that is not shown in any of the slides here. The projected growth factor, so that's what the auditor will let the governmental units know for budgeting, that they can expect a 3.5% increase countywide. So right now, without doing anything, they're expecting $13 million more per year starting next year just by an increase in the tax levy. So we have a simple choice. We can continue the bureaucratic micromanaging of business or create a competitive free market environment, frankly, with very little cost other than to the economic development corporations and those that make a living doing economic development work, simply by just getting out of the way. Thank you for listening to the presentation.